We'll be starting with a new topic, investment decision techniques. So let's reflect on what exactly is investment decision techniques and why do you really need to know this? Well, let's take a simple example. Let's say you have to travel every day 20-30 kilometers to your college or to your place of work, and for that you're evaluating whether you want to buy a car or let's say you can take a taxi. Which of these decisions would be more appropriate? So in a very simple way, investment decision technique may be just simple whether to take your own car or take a cab, or it could be setting up your new business, whether it makes sense to set up that business, what is the form of investment you should be making in that, or it could be investment in real estate, or you should be investing in stocks, at a complex level. So it ranges. So you will see that investment decisions are all around us. And this video will be covering the topic time value of money. What you will be learning in this are three topics. First is time value of money, future value and how to calculate future value, concept of compounding. What is time value of money? Well, time value of money refers to the fact that a rupee in hand today is worth more than a rupee promised at some time in the future. Let's take an example. Let's say you have 100 rupees today versus you have 100 rupees after 5 years. Out of these two scenarios, which one do you think is more valuable? As per the time value of money, the money that you have today, that is 100 rupees, is more valuable than 100 rupees that you would be getting after 5 years. So let's extend this conversation. In this example, when we are saying that something worth today is more than something worth in the future, there is a simple assumption that you're not making any money, any extra money which is in the form of interest. Let's say there is a scenario that you're earning, or let's say you go to a bank and you deposit this money into a bank account, and that bank account gives you a return of say 8%. And let's say overall you will be making simplified 40% in 5 years. So this becomes 140. So this 100 rupees becomes 140 in case you earn 8% per annum simple interest, which is basically 40% growth in your money, and this money becomes 140. This is also called future value, denoted by FV. So future value basically refers to the amount a given sum of money today would grow to over some period of time at some given interest rate. In our example, what we took was our 100 rupees, which is today's value, grows into 140 rupees if it is earning 8% per annum as the simple interest. Let's apply the concept of future value with the help of the same example. That is, let's say we have 100 rupees today, and let's say you deposit this 100 rupees in a bank that earns you 12% per annum. Per year it earns you 12%. What would be the value after 5 years? In our earlier example, we took the interest rate as 8%. And between 100 rupees today and 100 rupees after 5 years, we saw that as per time value of money, the money you have today is worth more than the same amount in the future. In this example, what we are saying is that 100 rupees today is earning 12% per annum. What would be the value at the end of 5 years? Let's see, we have this timeline starting from today. We denote that with 0. Then we have 1 year, 2 year, 3 year, and 4 year, 5 year. So the question is, if we have 100 rupees today and that earns 12% per annum, what will be the value of this 100 rupees in 5th year? So let's do that as year by year calculation. Let's say year 1 we write here. So 100 rupees is deposited in a bank that earns you 12%. So this is 12 rupees that you earn. So in year 2, what we are really investing is not 100 rupees, but rather 100 plus 12. So we are investing actually 100 plus 12, that is 112. And this earns 12%. And now we see that for year 3, this value is 112 plus the 13 rupees 44 paisa that you earn here. So the value is 125.44. So now in year 3 this earns 12%, 15.05. Similarly, we will calculate for year 4 and year 5. So in year 4 this is 125.44 plus the interest of year 3, which is 15.05. This becomes 140.49, 16.86. Similarly for year 5, this becomes 140.49 plus 16.86. This becomes 157.35, and this earns 12%, which is 18.88. So for year 5, which is the value we are looking for, we need to have this value and this value added together. So I'll just write it here, 157.35. This becomes 176.23. So our value here is 176.23. So did you observe that our 100 rupees today actually has become 176 rupees in 5 years? This is your current value, and this is the future value. So our future value, if this 100 rupees earns 12% per annum, becomes 176. However, if you do simple maths, our year 1 earning was actually 100 multiplied by 12, which is the interest that you earn basis 12%, is 12 rupees, right? And if we were to look at this for 5 years, then we would do simply just multiply by 5, which is 60 rupees. However, if you look at the future value, if I deduct the amount that I invested, what we have is 76. This difference that you see between 76 and 60 is 16. What is that difference, and what is really causing this difference? So if we look at our calculation here, you see that year 1 our interest is 12. Year 2 this interest is 13.44. Year 3 15.06. Year 4 16.86, and year 5 it's 18.88. We can see that our interest is not just 12, that is also rising. And what is causing this rise? Let's look at our year 1 and year 2 difference here. Let's say year 1 we are earning 12 and in year 2 we earned 13.44. So the difference is also called something as compounding. That is, the interest is earning an interest. So if we multiply this 12 by 12%, which is for year 2, this becomes 1.44. If you add back 12 to this, it becomes 13.44. So what we earned in year 0 to 1 is 12, which was 100 plus 12%. In year 2, we see that this actually becomes 112. And this difference of 1.44 is actually driven by this 12 rupees that is added back to the amount of investment for year 2. And that's why if you total up the difference between all these numbers, 13.44 minus 12, 15.05 minus 12 and so on, if you total up from year 1 to year 5, it will come to be 16, which basically denotes the interest that your interest is earning, also called something as compounding. So the calculation of 100 rupees becoming 176 can also be done with the help of a formula. Here our amount is equal to principal multiplied by 1 plus r raised to n. Just to let you know, this amount is also referred as future value. So this is basically future value. In our example, this became actually 176. Principal was 100, what you invested earlier. You started with 100 rupees. Your R in the example that we took was 12% and N was 5 years. So let's see what all this denotes. Amount is basically the future value of money after N time periods. In our case, it was 5 years. Principal is the present value of money, the 100 rupees. N is the time period, which is 5 years. And R is the rate of interest for 1 unit of time period. So R in our case was 12%. If we apply on the same formula, the answer comes 176. Let's calculate that. So this is basically 100 multiplied by 1 plus 12%, 12 by 100 raised to 5. So if you calculate this, it will exactly come as 176.23. 176.23, which matches with our year by year calculation. What do you think would be a difference in case 12% per annum is changed to something as 12% per annum paid quarterly? So let's extend this discussion. I'll just write it down, what we are looking at. So let's take the same example, which is 100 rupees today, that is present value or current value. What will be the value after 5 years if this money earns 12% per annum, but the interest is paid quarterly? So intuitively, compounding is the interest that you earn on interest. So if the interest is paid quickly to you, then you'll end up making more money. So intuitively, our value should be more than 176 in this setup. However, what changes in the formula? So we showed that amount or future value is equal to principal multiplied by 1 plus r raised to n. So what changes in this equation? Our principal remains 100, but our R, which is the interest rate and time period, changes. So in 5 years, how many quarters would be there? Quarter is 3-month period. So there are 4 quarters in an year, which actually indicates 20 for N. And for the interest, this is being paid quarterly since 12% is the per annum. So 12% divided by 4 is your quarterly, per quarter, I would say, per quarter interest. So 100 multiplied by 1 plus 3 divided by 100 raised to 20 is the value that we will get, and the answer for this would be 180.61. As you can see earlier, when we were paying the interest annually, our answer was 176.23. So the difference, as you can see, you get more interest because of the compounding. So there are 2 aspects that you need to understand. When your money is earning some interest, there is a future value. It will not remain the same, it will grow. And secondly, there is a concept of compounding, where that interest, when that growth also earns a growth, that interest earns an interest, you get more than what you actually invested and the interest part. So as we have seen that your 100 rupees became 176 if paid annually, and the same thing increased to 180.6 when the interest was paid quarterly. Primarily because as the frequency of payment of interest is increasing, you are getting more money to be invested, and that interest is earning more interest. So in this video, what you have learned is the concept of time value of money, that something is worth more today than in the future if it is not earning anything. However, the same equation changes when your money starts earning something. So that is something called as future value. That is the value of your money invested today. What will be the value in the future? And there is a concept of compounding, which is when your money is invested and that money earns an interest, and that interest is also invested back, that leads to a higher return. That concept is called compounding. That is when your interest earns interest. Thank you for watching. We will continue our discussion on investment decision techniques. In this video, we'll be covering understanding and calculating discount rate and present value. Specifically, you'll be learning 2 topics. That is, first we will cover the concept of what is a present value and how to calculate a present value. We'll also discuss upon the concept of discount rate and how to calculate a discount rate. In the previous video, we learned how to calculate future value of a current sum of money. Now there are times when we have future value and we may want to calculate what is it worth today, or what is the present value. So the current value or the worth of money today is also called present value. The way we calculate future value by growing current sum of money at a given rate over a period of time. Similarly, we calculate present value as discounting the future value. Think of it as the opposite. If you look at the formula where we have future value is equal to principal is basically current value, it is also called present value, multiplied by 1 plus r raised to n. So what we have to do here is to really find the present value. So let's do that as let's solve this equation. So present value is equal to future value divided by 1 plus r raised to n. Since it's in the denominator, that's why we call this as a discounting of future value, right? So this part of the equation actually moves to the denominator. You get present value, and as I said, this P is also referred as present value. Now determining R that is the discount rate, can be quite tricky, and present value would change with R. Higher the R, lower will be the present value since we are discounting. So if we increase the discounting number, it will lower down the present value. And that can have a great influence on your investment decision. So at a very basic level, we can take R as the prevailing interest rate. So previously we took 12%, so we can assume 12% for our example. So we need to find out 100 rupees 5 years down the line would have a present value of what in today's term. So let's take the same example as, we said that today we have 100 rupees and after 5 years also we have 100 rupees. And when we started our conversation on time value of money, what we mentioned, the value of 100 rupees after 5 years is actually lower than 100 rupees of today. In this video, numerically, we'll try to prove that. And that is the concept of present value. So what we are really trying to find out is what is the worth of this 100 rupee in today's term, which is we need to bring it back to today's term. So simply speaking, if we have to put it in this formula, so this 5 years from now the value is 100 rupees, so that is basically the future value. In our case, this is the N, which is 5 years, and R we assumed in our earlier example was 12%. So what we are trying to do is we'll fit into this formula. So let me just write it here. So 100 divided by 1 plus 12% raised to 5. So if we try to solve this, this will be 56.74. So what does this really mean? That although we were looking at 100 rupees 5 years from now, but the worth of that 100 rupees in today's time is 56.74. And that is the reason we said that 100 rupees of today is more valuable than 100 rupees after 5 years, because the real worth of that 100 rupees after 5 years is just 56.74, lot lower than our 100 rupees today. In this example, for simplicity, we took the discount rate R to be the same as interest rate, that is 12%. However, for most of the investment decisions, arriving at appropriate discount rate is more complicated than simply taking interest rate. We will deep dive into this in next topic with example of an actual investment decision that one has to make. Stay tuned, I would be covering that in the next video. We'll continue our discussion on investment decision techniques. We'll be specifically covering net present value in this topic. What you'll be learning are a couple of things. The first is the concept of cash flow for a business and how to calculate cash flow. The concept of cost of capital, also referred as weighted average cost of capital. How to calculate a discount rate, and the concept of net present value and how net present value is used as an investment decision technique. So let's get started. Let's say you have a business idea. You're fresh out of college and you feel that in your colony, in your area, there is no coffee shop. So you're excited about your new idea of setting up a coffee shop. Well, any idea requires some bit of scratching of head. And what is that? Every business idea needs money. So you're worried in terms of how much money will you require. So your first level of assessment goes into what exactly it takes to set up a coffee shop. And you scratch your head to figure out those things. Well, those things would include an initial setup cost of things like furniture, equipment, which may include different machines, including coffee machine. You have to probably hire an interior designer to set up things. You need to have all sorts of glasses and everything which is required to make a coffee shop more attractive and more pleasing for people to step in. And usually coffee shop will be in an area which is not very crowded, and people just come in there and have a cup of coffee and relax. So these are a couple of things that come in your mind, and you do your due diligence in terms of what exactly it would cost. So you come up with a number that it will cost somewhere around 8 lakh rupees, and this number probably includes pretty much your cost to initial for the initial setup, and that is good enough for people to come in and pay you for a cup of coffee. While 8 lakh rupees is a cost, it is not an income. So this is the money that is going out. The next thing that you start thinking is what exactly you will be making from this business. So you do some kind of future projections related with revenue and cost associated with your business. Well, first assumption you make is your business will start with a revenue right away. Unlike other businesses, say if you were to set up a technology business, maybe first initial years are spent developing a product, right? So there is no revenue. But when you're setting up a coffee shop, there may be initial revenues. You will start with some bit of revenue as soon as you open the shop, right? So you expect that in next couple of years your sales will be there and they will continue to grow, and because you feel word of mouth, if you're doing the right thing, you will continue to grow your business and more customers will join in, and this number is certainly to grow over the next 5 years. You also think of what are the possible costs on an ongoing basis every year, let's say for next 5 years, that you have to consider. Well, these costs may include rent, rent of the place that you need to take, salaries of staff, 1 or 2 staff along with you, they have to be paid certain salary. Raw material is required to make coffee, which would be coffee bean or whatever you get in terms of packed things to make a coffee, and stuff like repair, maintenance cost associated with electricity and so on. And you expect that as revenue increases, there would be some cost that may be fixed, but other cost will be variable. But overall you feel that the cost will also increase. For example, rent may remain the same, but as the business grows, you may have to hire more people, so the salaries have to be paid higher, and even the raw material will be used more when you have to produce more cup of coffees. So you expect the cost also to increase over the next couple of years, and you make up this projection. So here are the projections of what is the cash coming in, which is in the form of revenue, and what is the cash going out, which is in the form of cost. And there is something called net cash flow. Net cash flow is nothing but the difference between what is coming in and what is going out. So this is cash inflow and this is cash outflow. So if you deduct this, 5.5 lakhs minus 4,12,500, whatever value you get here is net cash flow. So what we are trying to say is for year 1, there is a net cash flow, and that net cash flow is also donated by CF1. Similarly, for year 2, it's donated by CF2, CF3, CF4 and CF5. So all these numbers indicate what is the net cash flow, that is what you have earned and what you have paid out, what is left with you at the end of this cycle. So here we have that number, that is the net cash flow number. So I'll just write it down, it's net cash flow. So this is for CF1, CF2, CF3, CF4, CF5. And just remember that we have not considered the initial investment of 8 lakh rupees. You remember 8 lakh rupees is to be spent at the time of setting up your business, that is buying furniture, paying to the interior designer, buying machinery and all those things. Even raw material initial investment is required. So we have not considered that amount. We have just considered year 1, 2, 3, 4, 5 cash flow situation. So that's why I've just mentioned 8 lakh rupee here, which I can actually say is 0, which is the current investment that is required to be made. So now we have the initial investment of 8 lakh rupees, plus we have all the future cash flows. So we have 3 ways we can evaluate whether one should invest in this business or not. So these are net present value, internal rate of return, and payback period. In the coming videos, you will cover up all these 3 ways of assessing whether setting up the coffee shop is a sensible decision or not. Thank you for watching. So let's continue our discussion on investment decision technique. In this, we'll start with net present value. You'll be learning about how to use net present value in evaluating your investment decision. So what exactly is net present value? Well, it is basically difference between the present value of future cash flow and the initial investment. As you can recall that the initial investment amount in the example we took was 8 lakh rupees, which was the initial setup cost of setting up the coffee shop. And we have 5 years of future cash flows. Remember, those were not present values of future cash flows. Those were just the future cash flows for the next 5 years. So you remember this table that we showed, revenue minus cost, which is cash flow for the next 5 years. Let's plot this in a timeline. This is the timeline with years 0 to 5 years. 0 is the current, 1, 2, 3, 4, 5 years, and associated cash flow is what we have here, which is 8 lakh rupees is going out. That's why you see a negative sign there, and rest of the cash flows are all positive. That is, revenue minus cost is a positive sum. So now we need to apply net present value technique in terms of understanding whether to go with this decision of opening the coffee shop or not. So as I said that these are all future cash flows, what we really need to understand is what is their present value. So present value will be all in today's time, what is their value. And similarly for 5th year also we need to understand what is the value of in this 5th year in today's terms, so that 8 lakh rupee becomes comparable to all other cost for CF1, CF2, CF3, CF4, CF5. So let's see in terms of the formula here. In order to convert this value, let's say this value in today's time, how can you do that? So present value formula, if you remember, was future value divided by 1 plus R raised to N. So this 137,500 is the future value which fits into this formula. 1 plus R raised to N. N is 1 here in this case. R is something which we will be discussing in a bit. That is also called discount rate. Hold on for that. But this is the way it will fit in. R, as you can understand, will be a percentage number. We'll understand how to calculate R, but this is the way this formula is calculated. Similarly, I will just put here only, since this is for second year, so this becomes this. I'll just write it down. It becomes 137,500 divided by 1 plus R raised to 1. Sorry, it will not be 2, it will be 1 in this case. Similarly, for third year, we are doing the same thing, which is 1 plus R raised to 3, 1 plus R raised to 4, and 1 plus R raised to 5. This is applying the same formula as we learned earlier, that is present value formula. So we are just adding up all these numbers to get to today's value. And when we deduct all these cash flow numbers in today's value from the net cash outflow, that is called net present value. So I'll just put it like this. So the answer, when you solve this equation, will be the net present value. That is the present value of future cash flow minus the cash outflow in today's time, the initial investment amount. So what we have learned here is how to apply present value formula in order to calculate net present value. If you remember, our present value was associated with only one number. Here we have multiple cash flows which are varying in terms of the value also. So just by looking at the number, it will be very hard to say what will be the present value of these numbers. So present value of any number will obviously depend upon the future value, and also something as R, which is the discount rate. So in the next video, we'll be discussing about how to calculate a discount rate. So what discount rate you should be taking to discount future cash flows? You remember in the previous video, we had mentioned cash flows and we had pretty much everything. We had the initial outlay of 8 lakh rupees, then 5-year cash flow. But what we did not have was something called R. R is the discount rate. It is also called cost of capital. So what exactly you think that should be the cost of capital that you should be taking for your investment, and how you should be really thinking about that? So we know that initially when you have to start off, you need money, and that money is 8 lakh rupees. Well, you're fresh out of college, the chances are you may not have as much money as it is needed for setting up your business. So what you do is you scratch your head and you figure out you can very well walk into a bank, right? A bank can really lend you money and you can start your venture. So your sad face will turn into smiling face if the bank allows you to give money. So let's say bank gives you money that you need, let's say 8 lakh rupees, but bank normally charges interest on their loan, right? So that 10%, let's say 10% is the interest rate that the bank is charging. For example, for every 1 lakh rupee, you pay 10,000 rupees to the bank. Similarly, for 8 lakh rupees, there will be 80,000 rupees that you have to pay to the bank. That is the cost. So the cost of capital for you in this case, when the bank is lending you money at the rate of 10%, the cost of capital is 10%, because that is the cost associated with having that capital. Well, now you're again sad because you feel that's too much of cost that you need to bear. How about just going to your father who has been taking care of you and asking money from him? that will have no cost. What do you think? Do you think having money from your dad, let's say your dad decides to give you 8 lakh rupees, that money, the cost of capital will be 0? Well, the answer is no. Let's say your dad has been saving for that money for, let's say, for his retirement or for your own future, but he decides to lend that money or give you that money, which probably you don't even have to pay back to him. But there is something called opportunity cost. Let's say that money was lying into mutual funds and those mutual funds were earning 12% per annum. Your opportunity cost is 12% in that case. That is basically the opportunity your father is foregoing by investing that money into your business, and hence in this case the discount rate would be that opportunity cost, that is 12% that your father was earning in mutual funds. So let's think of a scenario here. Let's say after figuring out that there is something called interest cost, which you have to pay to the bank in case you were to take loan from a bank, and there is something called opportunity cost, the opportunity that is foregone in case that money is used elsewhere. So a discount rate is basically a combination of this real cost, also called interest cost, and the opportunity cost. So if you remember, the real cost in our case would be the interest cost. The interest is basically what you are paying to the bank, and this is the opportunity cost, say a return on a mutual fund that your dad was earning. So your cost of capital, also called discount rate, is a combination of these two. So let's say you decide that 8 lakh rupees you want, but you decide that 2 lakh rupees you will get from your bank, and because you cannot afford to give so much interest on an ongoing basis, and your father decides to give you 6 lakh rupees. So I'll just write it down here that this money is given by your father and this money is given by your bank, right? And let's say this money we arrived at 12% per annum is the opportunity cost for this, and in this case we said that 10% per annum is the interest cost. So how do you really arrive at a common cost of capital combining both these factors? When we combine both these factors, this is also called weighted average cost of capital, also called WACC. So let's see how this is done in practice. Your total is 8 lakh rupees. Right? So we have to assign weights. That's why there is a weighted cost. We know the cost is 10% and 12% respectively in this, but the weights are different. So what we are taking from bank is 2 lakh rupees out of the total 8, and in case from father we are taking 6 lakh rupees out of the total 8. Right? So these are, this is how much you are getting from your bank, and this is how much you are getting from your father. This has a cost of 12% and this has a cost of 10%. When you combine this equation, you get weighted average cost of capital. So you can see, this is called weights and this is called, cost or whatever. I am just writing it K. So our weight here is 25%, which is 2 by 8 multiplied by 10. So from this we get 2.5%, and from here, which is 75% weight, which is 6 by 8, what we get is 9%. So when we add these two, we get 11.5%. So the cost of getting this money, 8 lakh rupees, the cost of capital for you will be 11.5%. This is our cash flow and cash outlay. We know that initially we have spent 8 lakh rupees and each year we are getting cash flows. This is net of revenue and cost. So now we have the cash flows. Let me just add this up, as we have shown that net present value is the present value of future cash flows minus any initial cash outlay. So 8 lakh rupees is the initial cash outlay, and here we need to find the present value of each and every term here. So I'm looking at year 1 cash flow, 137,500 divided by 1 plus 11.5%, as we calculated our R to be 11.5%. I'll just write it here, 11.5%. Similarly, this becomes, so this is 1 raised to 1. This is 11.5%. This is 2. This is 1 plus 11.5% raised to 3, because this is third year. And similarly, we have 4 and 5. So let's see what are the values of all these 5 cash flows. So these will be present value. So what is the value of this in year 0? That is the current value. So when you calculate this, you get 123,318.89, which is the present value of year 1 cash flow. Similarly, you will calculate for all the rest of the 4 years. So what we need to do is, these are all present value of future cash flows, right? So we need to add them up. So the total of this would be 7,18,045 rupees and 44 paisa. So we can see that, what we are getting in the next 5 years, assuming, after 5 years we don't have any other cash flow. In 5 years, we are getting in total 7,18,045 rupees as against our investment of 8 lakh rupees. So in this case, if I were to calculate the net present value, the net present value will be equal to 8 lakh rupee, which is the initial investment, plus the present value of all future cash flows, which is 7,18,045. This is 0. So if you were to open this cafe, you will be incurring a loss of 81,954 rupees and 56 paisa. This is a negative number. This is a loss. So based on the NPV method, you should not be opening this cafe, because if you go with this cafe, you will be incurring a loss. So let's build a net present value model here. Let's say these are the years we have, and this is the revenue and cost number. So first of all, what is the cash flow for each year? This is exactly the same as I was showing up on the screen earlier. So this is net cash flow for each year. So let's just make it more. Let's say we call this as discount rate here. Discount rate, we know that it is 11.5%, sorry. I'll just change the formatting here a little bit. So let's say this is bold. We have a discount rate and then the discount factor, which is 1 divided by 1 plus R raised to raised to is on 6 that you see sign, this inverted sign, inverted V. This is you will find under 6. If you control shift it will appear, and then 1. One more thing you have to do is you need to freeze this cell. So you can place a dollar sign here and it will freeze. When I say freeze, that means even if you have to drag the formula, this particular cell will remain fixed. This will not drag. Well, shortcut of this would be placing, just if you press Fn F4, this will get changed, or it can be placed with the command key. You don't have to place the dollar sign in that case. Again, it's Fn plus F4, and when we drag this, you will see that the formula will be copied. As you can see, it's fixed to 11.54, and since we are looking at double digits only, so here is the discounted factor. Now we say that we need to calculate present value. This is present value of, actually from a formula, the modeling point of view, this can be placed at the top, this can be placed here, so that it's in one sequence. Instead of bold, this can be just italic, and this is the present value, so which is basically 137,500 multiplied by 0.9. If I just stretch this, have these numbers, maybe I can get rid of decimals here. So these are, so if I have to calculate the net present value, it will be, and just remember that whatever you have to fill, it's better to have a different color. So this is something to be filled, as well as these cells. Alright, and this is all calculation, so you don't have to touch these, or anyone who is using this. And similarly, I'll insert a line here, probably here from a sequence, which is the initial investment. Initial investment also needs to be filled up, so it's better to use this color. And well, this is not in percentage, it's alright. What we really need to calculate is the net present value, which is the answer, that is initial investment, which is minus 8 lakh plus sum of all the present values of future cash flows. Well, this is where modeling helps. I see that when I was writing this number, this is incorrectly mentioned. It should be 153,984.67. So this number is actually incorrect. So this is what modeling helps with. When you do it in Excel in a structured way, you really avoid any manual mistakes. Similarly, I see that even this number is incorrect. It should be 718,304.24, and our NPV will also change a little. Well, our decision will not, because it's just a 200 rupee difference, which will not really cause any change, but this number would vary, which is it becomes 81,695. 81,695. That's the NPV of this project. So which basically means it's a negative number. You should not really pursue this project. So in this video you have covered a lot of things. Firstly, we understood what is a cash flow for a business and how to get to the cash flow, which is revenue minus cost. We understood what is NPV. NPV is initial outlay minus present value of future outlay. In our case, we started with cafe business and we figured out that it's a loss-making business, assuming after 5 years there were no cash flows. We also understood what is cost of capital and what is weighted average cost of capital. You assign weights and the associated cost to get weighted average cost of capital. It's a combination of real cost, the cost that you pay to the bank or when you borrow, and opportunity cost, in case you have to take it out from somewhere and then put it in the business, you have to really consider what it was earning, what the money was earning before. We understood how to calculate net present value, and we were able to set up the Excel model to calculate NPV, and that indicated that there is some error in our manual calculation, which we fixed, reinforcing that modeling has its own benefit of avoiding any calculation, and it really indicates where the error could be. Thank you for watching. We'll continue our discussion on investment decision techniques. In the previous video, we discussed net present value. Now we are moving to the second method of investment decision technique, which is IRR. That stands for internal rate of return. In this video, you'll be covering two topics. One is to understand what do you mean by internal rate of return, and the second is how to calculate internal rate of return. Internal rate of return is also referred as IRR. So what do you mean by IRR? What is exactly internal rate of return? It is basically a return that you are getting on the project. It is a discount rate that equates the present value of project's expected cash inflow to the present value of project's cost. In simple terms, it is a return that you earn on your project. How do you calculate IRR? Well, it is a return on your project, but simply speaking, if we look into our NPV formula, it is basically the discount rate at which the NPV becomes equal to 0. So wherever the NPV becomes 0, the discount rate that you're using is basically the IRR on your project. So this is our example that we are taking, that you're setting up a cafe, and for that coffee shop, what you need is an initial investment of 8 lakh rupees, and we arrived that there is a future cash flow, that is revenue minus cost, for the next 5 years. So we understood in NPV, what we took was we assumed a certain discount rate. If you remember, we assumed 11.5% as the discount rate. But in this case, what we are really saying is we need to really arrive at R. For example, I'll do the same thing as I did in NPV, but without the 11.5%, because that is the value we need to find out. Well, this is exactly what you saw in NPV calculation also, but in NPV we took R is equal to 11.5% that was given to us, or we calculated 11.5% basis what you're getting from your father and from bank, and we calculated weighted average cost of capital. In this, we are assuming that R is not given to us, and then we need to find out at what value this NPV becomes equal to 0. So let's open the Excel that we use to set up the NPV model. Alright, so this is the sheet that we created to calculate NPV. In this, you are saying that the NPV is a negative number, that is negative 81,000 something. So what we are really saying, in order to calculate IRR, what we really need to do is make this value go to 0. So let me just make these changes in the discount rate to really arrive at what would be that value. So let's take 6%. So we see it's a positive number. Let's increase it to 8, negative. I'll keep it 7, 9 here. Looks like it is 7.78 or something. So it's anywhere between 7.78 to 7.79. So somewhere close to that. And we've brought the NPV very close to 0. It's just 44 rupees. At 7.8 it's becoming negative, so we can assume it's somewhere around 7.8%, just to simplify. So as you can see, that IRR is basically a trial and error method which we are trying to put here, and that is helping us arrive at the value where the NPV becomes 0. So what is the rate, a discount rate at which NPV becomes 0? So it becomes a trial and error method. However, let's take this initial 11.5% only, and let's bring our knowledge of goal seek that we studied in Excel when we were studying Excel. So let's apply goal seek formula here. So as per the goal seek, you go on data sheet, you go on what if, there is goal seek. So what we really want is we need to set this cell equal to 0 by changing the discount rate. By changing the discount rate. So if we hit OK, it will automatically calculate what is that discount rate. So as we can see that 7 point, and it will, if you just increase the decimal points here, you can see that it's calculating the exact number at which NPV becomes 0. So doing this manually would have taken us a lot of time, but GoalSeek does it very quickly. So that's why GoalSeek is a very effective tool that you can use to find out what is the IRR on a project. So let's say we have arrived at this number here, which is 7.8, just to simplify, 7.8% as the discount rate. What does that really mean? So let's say if we had taken all the money from the bank, then whatever profit we were earning from the business, all of it would go to just paying the interest of the bank. If you remember, in our previous video, we assumed that bank is lending us money at 10% per annum. And if your project is earning 7.8%, which is less than your interest cost, pretty much what you're doing is you're incurring loss. And think about it, if you had taken all the money from your dad, then that would have, the cost would have been 12%. That what it was earning in the mutual fund. Earning 7.8% would have been even lower than 12%. And in our previous example, when we took 25%, that is 2 lakhs from bank and 6 lakhs from your father, even in that it was 11.5%. The earning on this project is 7.8%. So in all the scenarios, we can see that our earning is lot less than the opportunity cost or the real cost of the project. So the project is basically having a profitability less than the cost, which is exactly the same thing as we mentioned in NPV, where the NPV was negative. We said the project is not a good project because you'll be incurring loss. Even as per the IRR method, we are getting the same answer, that is, you should not pursue this project and it will eventually lead to losses. So similarly, if our cost would have been lesser than, let's say, 7.8%, let's say it was 5%, then earning 7.8% more than the cost would have made sense. So the project would have been a good project, but basis the same example, our NPV would have been positive as well. So what all did you learn in this video? Well, you understood the concept of internal rate of return and you understood how to calculate IRR. You used two methods to calculate IRR. One was the trial and error method. The other is that you use a function that is part of the Excel, that is goal seek. So you applied goal seek function in order to calculate IRR for the project. Thank you for watching. We'll continue our discussion on investment decision techniques. In this video, we'll be covering payback period. You'll be learning two aspects of payback period. One is what is the concept around payback period, and second is how to calculate payback period. So what exactly is payback period? Well, a payback period is the length of time that it takes for a project to recover its initial cost out of the cash receipt that it generates. So simply speaking, this has been a traditional way to look at any business in India. For example, if you're investing certain amount, how quickly you can recover that certain amount in simple ways, what is termed as payback period. So let's look at the cash flow of our cafe business. We have the years from 0 to 5 and we have the associated cash flow. This is the same cash flow as we have been using in the calculation of NPV and IRR. So if you remember, as per NPV and IRR, our outcome was we should not pursue this project. Let's see when we are using payback period, what's going to be the outcome. So if you remember, in NPV and IRR, both, we were dividing or rather discounting the future cash flows. NPV was same present value of future cash flow minus the initial outlay, indicates whether it's a positive cash flow kind of business or not. Similarly, IRR is the rate at which NPV becomes 0. In both the cases, it was discounting the cash flows. However, in case of payback period, we are not discounting any cash flows. So it's actually a simple maths if you think about it. For example, in this case, what we need to do is we need to add these cash flows. And we need to get to the point where the total of these cash flows is actually equal to the 8 lakh rupees that you're investing as initial cost. So cash flows for adding all these 4 years of cash flow, the total is 738,100, and we know that when we add some portion from year 5, we know that the payback period is between 4 to 5 years. That is, whatever initial investment you have made, you will be recovering that between 4 to 5 years. So the difference between 8 lakh and 738,100 is 61,900 divided by, our cash flow is 285,120. So this is 0.22 plus we have complete 4 years. So we have 4.22 as the payback period answer to this scenario. As I said, even without doing this calculation for the last step, we could figure out that the cash, the payback period is between 4 to 5 years. In order to calculate exact years, then this is what we have done, which is whatever is the difference between what you need to get from year 5. You take that cash flow, which is the difference of 8 lakh and 738,100 divided by the cash flow of 5th year. There you get 0.22 and 4 years is clean 4 years for the first 4 years cash flow. So what does this really mean? Well, if you just look at this number of 4.2 years, what we really mean is, let's say if we are looking at a cash flow assessment of 5 years, 1 to 5 years, we are basically saying that majority of our initial investment, that is the cost, will be recovered only towards the end of the period. So in the first two method, NPV and IRR, this does not really make sense to pursue the coffee business, opening the coffee shop. In payback period, we are getting a number which is 4.2 years. And what we are saying is we are able to just recover the cost in 4 to 5 years. It basically means that there is no profitability you can expect from the project, because in a way whatever is your initial cost, you're just recovering that by 4 to 5 years. So the scope of making profit happens only after once your initial investment is recovered as per the payback period. So even as per the payback period, this project does not make lot of sense, which matches with our initial assessment of NPV and IRR also. As you can see that we have not really discounted these cash flows. These are simply taken the way they are. So in a way you can say that it ignores the time value of money, which is the biggest shortcoming of payback period. It does not consider the time value of money, which makes this method more inferior to NPV or IRR method. So unless you discount these values in today's term, it makes no sense to have this comparison, because something you're getting in the 4th year. So this cash flow, for example, is not comparable to this cash flow, which is today's value. So 8 lakh rupee of spent today is not comparable to cash flows that are happening in the future. So in a way you have to have a apple to apple comparison. So payback method actually does not consider that aspect of investment decision. So in this lesson you understood the concept of payback period and how to calculate it. Thank you for watching.